Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 328 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including the status of the Fear and Greed Index, corporate insider moves following this recent dip, historical data on secondary drawdowns during a year, S&P 500 price-to-earnings ratios, Thanksgiving week performance for equities, and an update on the American consumer. Aaron, thanks for joining.
I'm happy to be back. I'm two back-to-back this week.
I'm in for this.
2 weeks, so it's good. I'm getting back in the groove. I like it.
Hey, you can't have enough of AC. You have excellent content and good viewpoints. Looking forward to seeing what you have for us this week.
Absolutely.
How about you start off with pricing for our viewers and listeners, and then I'll take big headlines and current events.
Perfect. Sounds good. Starting off with the S&P 500, its month-to-date performance is down 2%. Year-to-date, it is up 14% even. The Dow Jones Industrial Average is down 2.3% month-to-date and up 9.2% year-to-date. The Nasdaq Composite Index is down 3.6% month-to-date and up 18.4% year-to-date. The iShares Russell 2000 ETF, for small caps, is down 2.6% month-to-date and up 8.6% year-to-date. The Vanguard FTSE All-World ex-United States Index Fund, it's a mouthful, is down 2.1% month-to-date and up 23.9% year-to-date. Checking in on treasuries, the 3-month treasury yield is sitting at 3.91%. The 2-year treasury rate is sitting at 3.46%, and the 10-year treasury is at 4.04%.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today. It's going to be interesting. I got some talking points here on big headlines and current events talking about the Fed. But before we get there, it's going to lead us into, the jobs data in general is coming in slightly stronger than the market was expecting. What happened about a week ago when I was preparing some of these podcast notes, Aaron, is initially that news started to lower the expectations of a December Federal Reserve interest rate cut. And I know that you discussed some of that on episode 327 that I listened to, right? And the reason I want to bring this up for our regular listeners is after that was discussed on the last episode, 327, I want to share this following what I call Fed speak that caught my eye. And when I use the term Fed speak in our industry, that means that there are speeches that some of these regional Federal Reserve governors will give in order to kind of communicate their opinions and or policy. Is that a good way of saying
Absolutely.
it?
Yep.
Okay.
Gives listeners or people in the market a feel for what the Fed's thinking.
Well said.
Yep.
Well said. And so to give some time elements to this, what I'm about to read is from November 21st at 8:35 a.m. Okay?
Perfect.
So this is what was said. And who is speaking is John C. Williams. He's the New York District Federal Reserve President, okay, of that district. And as you can imagine,
That's
New York,
big
deal.
Influence. Yep.
Okay. So this is 11/21. Williams revived December rate cut hopes, stating in a keynote address that he, quote, still sees room for further adjustment in the near term to the target range, end quote. Pretty direct.
Pretty clear. Yep.
Pretty direct, right? His views carry more weight as he is one of the core members of the FOMC. He voted in favor of lowering rates in October and added that while it is, quote, imperative to restore inflation to our 2% longer run goal, it is equally important to do so without creating undue risks to our maximum employment goal. Monetary policy is modestly restrictive currently. Inflation progress has stalled, but he believes underlying inflation continues to trend down and should be on track to 2% in 2027. While downside risks to employment have increased, in Q&A, he said clear communications can limit market disruptions. He suspects fiscal policy could be boosting the neutral by some 25 to 50 basis points. So in essence, at the end of the day, inflation, in their opinion, still coming in the mid-twos. You have a Fed funds rate that is in the low fours. It's got to come down.
Too much of a disconnect there.
Too much of a disconnect. Yep. So before we started taping the podcast, and to timestamp this is November 25th. Aaron Kramer checked the CME futures at 9:21 a.m., and it's currently indicating a probability of a rate cut at the December 10th meeting of 84.7%. Your comments?
Drastically different from last week when we did this same podcast.
Drastically different.
It was like a 65% odd that the Fed was not going to do anything. Yes, it's completely flip-flopped, which is interesting. So,
and I want to take a step back because that's an important point. If we think about the markets over the past roughly 3.5 weeks when we had this correction, I can summarize the reasoning for the market very quickly. Two main topics, and I think they were equally important for the market. What's going to be the trajectory of these Fed rate cuts? Because before going into the end of October, it was virtually guaranteed in the market's eyes
that we were going to get
a rate cut in December. And when the data, even with the government shutdown, was coming in stronger than expected, it started to throw cold water on that. That caused weakness. I was sitting there, and you heard me say on the podcast a couple of weeks ago, okay, so we don't get a Fed rate cut in December. We'll most likely get it at the end of January.
Yeah. Wait, it's not that big of a difference, right?
That's right. So I'll continue. And the second point is people were concerned about where we were in the AI data center building cycle. Everyone was waiting for Nvidia earnings, not a recommendation for or against.
And what do they do?
And they came out and they killed it.
Yeah.
And they had a good outlook. So I think this could potentially set the market up with more probability, in my personal opinion, going into year end higher rather than lower. Any other comments before I go to tweets, articles, and research?
No, I think that's perfect.
Okay. So my first thing that caught my eye was the recent data on one of the popular fear and greed indexes that CNN produces on their CNN money site.
Yep.
They have a proprietary formula that looks at a lot of different metrics to come up with this fear and greed index. And the scale is 0 to 100, 0 being bad, meaning extreme fear, and 100 being extreme greed.
Got it.
Okay. And what I will say for viewers and listeners to save time on the podcast is this index is disproportionately heavy on looking at the options market. And I won't get into that for our viewers and listeners, but this is looking for people who are either exhibiting a lot of aggressiveness to the upside or a lot of aggressiveness and thinking that, there's a lot more pain to come. And they're using the options market, I think, for that sentiment. Well,
interesting.
It's no surprise to me to see we have extreme fear. We are at a single 8 handle.
That's
on
low.
This. That's low on November 20th.
Wow.
And this goes back to comments I've been saying on the podcast now for a couple of months, that once we get a correction that comes, because we haven't had it in 5 or 6 months, it's going to disproportionately feel worse than it actually is.
Right.
And to sit here and to see these types of metrics,
while we're 3% off all-time highs,
keep going. As somebody who is not necessarily worried about the market where it's going to be 1, 2, 3 weeks from now, this if you're underallocated to equities, don't come crying to me at the end of the year. Okay.
Right.
All right.
Love it.
Item number 2. This is about insider buying. I saw this post from Christian from Hertz. I had to look up how to pronounce the last name.
Impressed.
Okay. So he's the CEO of Tribeca Trade Group. And he had this post on X on November 20th. And it has to do with corporate insider buying.
Interesting.
Okay. This is what Christian posted. buying this S&P dip at the fastest pace since May, corporate insiders. It says executives at publicly listed companies bought shares in their own firms over the past 30 days at the fastest clip since May of earlier this year. The ratio of insiders buying to selling is up to 0.5, data compiled by the Washington Service Show, as fears of an AI bubble sparked a broad rotation out of highly valued tech stocks. Insiders are buying as other dip buyers seemed skittish, within corporate insiders taking advantage of the pullback and putting their money into their own companies. If Mark McEvely were here,
That's not bearish.
That's not bearish, first of all. And if Mark were here, he'd sit there and say, hey, listen, I can give you upwards of 10 reasons why someone would be selling their own company stock that they work for.
They need liquidity, XYZ. There's only one reason to buy it, though, right?
What is it? You think
it's cheap.
Gonna, yeah,
it's
I think
cheap.
it's
on
going
their
to go
value,
up.
right?
So that's not a bearish data
Not
point.
at all. I like that. It was a very good data point.
And then the third thing I have this week is from a friend of the podcast, Seth Golden. Seth had a post on November 20th AC that kind of caught my eye. You could tell, Seth is a market strategist. And so someone said to him, Seth, do you think this is going to be a 10% drawdown? Obviously, with the market correction.
Last few weeks, right?
Yeah, last couple of weeks. And this is what Seth said in his post. In strong years where the S&P fell 15% plus earlier in the year and still made a new all-time high within the same year, secondary drawdowns always stayed under no more than 10%. The median second drawdown was negative 5.6%, kind of right around what we got.
Very familiar.
I think we got 6. That sound about right, sir? Maybe 7?
Yeah. Yep.
Depending upon the indice. November to December on average gained 9.3%. To verbalize the data set years, Aaron, 1980, 82, 98, 2020, and now. Okay?
All right.
So I just want to throw
Really
that
good
out there.
data
Lens
point.
of history would support a year-end rally. Okay?
Feels very familiar.
I mean, can you imagine when we get a rate cut in December 10th?
Should rip.
Oh, my goodness.
Should rip.
Gracious. Over to you, AC.
Awesome. I got a few good ones here. I've got an X post from Matt Sermonaro.
Cermatero.
No.
That's how we usually pronounce it. Cermatero is
There's no T in there.
That's how there is no T. That's how I've always pronounced it. Have I gotten that wrong consistently?
I don't know.
No one's ever corrected me on this.
It's got to be Sermonaro.
Has to be Sermonaro. There's no T.
All right. I digress. His X post says, hard to create a bubble narrative when the S&P 500's PE ratio has gone literally nowhere this year. So
it's true, though.
It's true. It's sitting, the average S&P PE is right around 24.5 multiple.
And that's trailing.
Trailing, yep. Forward is probably much lower than that, would be my guess. That 16, 18 range would be my guess. I don't know.
I think it's a little higher. I think you're in the 18s.
Okay.
But what I will sit there and say, I saw a piece by FactSet a couple of weeks ago. I believe I did talk about it on the podcast in early November. And it's showing what S&P index earnings are forecasted to come in for this year versus the estimate for next year. And I'll be in the rough vicinity here.
Yep.
I believe it was expecting around $267 of earnings on the S&P 500 index for this year. And the consensus estimate for next year was 303. So when someone sits there and tries to say to me, but Matt, these stock prices aren't supported by earnings.
But they
Give
are.
me an example.
Yeah.
Be more specific.
Right. Maybe one stock isn't, right?
Now, what the person could follow up with, which would have some credence, is, but Matt, the S&P is a market cap weighted index, and you have these top 20 names that might be doing really, really well, disproportionately well, which have more influence on the index, which pull that number up.
Sure. It's
But
true.
it still begs the question.
Right.
You can't project the image that stocks are moving higher this year,
When
but
the
the
average-
earnings aren't following.
Right. Exactly.
I mean, these are very broad general statements.
For sure.
This is not company specific.
Not at all.
But that's hard. That's hard to make that case.
It is. This is really good evidence that it's not that bubbly, let's say, if that's a word.
I'm just saying it'd be different if the earnings weren't following it.
Exactly.
Right?
Love it. Love it. Love it. And that was on November 19th is when he put out
Timestamp? Okay.
Yep, timestamp. All right. I got a fun one here. This is from Bespoke on yesterday, November 24th.
Always good stuff.
Yeah, they always have good research. Expo says it may be a short week, but Thanksgiving week has traditionally been good for equities. They have data going back to 1945. So the median return was 7.6%, and it was positive 65% of the time. It was up 10% plus year to date. The median return was 0.91% and positive 70% of the time. When the market was down 10% plus year to date, the median was 1.5% growth and positive 85% of the time. So,
those
in
are
all instances,
you're
relatively good.
Pretty good data sets there.
Absolutely. So, ton of data sets, a lot of cases, obviously, and it looks pretty good. So, we'll see. We've gotten a lot of volatility over the last few weeks, so it doesn't surprise me in a shorter, quieter week when not a lot of people are working and trading as much. The market does fine.
And we have a half day Friday too.
Low volumes, right?
Right.
Yep.
Okay.
So, pretty neat.
I like it.
All right, I got one more for you.
All right.
This Charlie Bilello ex post on November 23rd. This is a hot take by him, so I'm really curious to get your opinion on this.
All right, I'm in.
So this leads right into what we were talking about earlier with the Fed cutting rates. So Charlie says the Fed should hike rates 50 basis points in December. Inflation has been running at over 2x their target level, 2%. For 5+ years now. I'm curious where he's getting that data. The stock market and home prices are at record highs. Stop pursuing policies that will only create more inflation and worsen affordability. So it shows, he's got a chart showing actual CPI and the CPI at 2% inflation trends since January 25. His data set is from January 15th, 2015, I should say, and September 2025. So I think my opinion is he's siloing some data from inflation over the last couple of years, and inflation has been slowing. Is it under 2? No, but my quick opinion on this is if the Fed does this, the market is going to have a conniption fit, and I don't see it happening.
It would not be friendly.
And the Fed has basically said the exact opposite, right? So it's a hot take by him. Your opinion?
It's very hot, and I would throw this out there. My thoughts are as follows. We've had such a dramatic increase to the money supply the past 5 years that is something that the market and the economy just has to digest. That was a big meal.
Absolutely. Yep.
Okay. And you don't want to stall the plane out. And raising it 50 would stall the plane out.
Absolutely.
So this creates an existential question of, at what point is the Fed going to get control on the inflation front? And up until this point, what the Fed has been able to do was unheard of 3 years ago.
Right.
3 years ago, the market was certain. There's no way the Fed can thread this needle. They have up until this point. And it's no guarantee that they continue to do it.
But I'm
in this camp at the end of the day. Sometimes perception is reality. And I could make an argument that, yes, making money cheaper has a magnifying effect on the economy. But sometimes this stuff is psychological also.
Yeah, that's true.
Okay.
And with a fiat currency, we have to have a little bit of inflation. Otherwise, we would absolutely just stall out, right? There's nothing backing the U.S. dollar, right? So we have to have a little bit of inflation for our normal economy to function.
Yeah, and some people could also argue when you look at, let's look at the real estate market as an example, okay? So real estate prices nationwide have really been subdued the last year compared to the couple years before that. You are seeing things normalize in a little bit, I think, more efficient than the market was anticipating. And I think there's still this disbelief that the Fed has been able or will continue to be able to thread this needle, and they have.
Right.
I'm in this camp that he's taken the aggressive, hey, at some point we got to make a tough decision approach. I'm just in this camp that
not yet.
This
right.
has been this way my entire career. Okay. And so, for over 25 years, I've seen it always be the kick the can mentality for better or for worse. And guess what? I just don't see it stopping anytime soon.
I would agree.
So again, I think it is a hot take. But, I think the biggest factor that people just have problems really getting their arms around is just how substantially our money supply has increased.
Yeah,
I mean, let's go back to the PE conversation, okay? So when someone sits there and says, hey, XYZ stock is expensive because it trades at a forward PE of 22 or 23.
Right.
I've been told, Matt, that I only buy stocks that are under 18. Okay.
But there's also an extra $1 trillion out in the system, or rough numbers, right?
Exactly. So
relative to a decade ago,
how are we going to start looking at valuations that are priced in a currency that increased its money supply by 50%? When are we going to take that into consideration?
Yeah, that's a good point.
No one wants to talk about that.
Nick and I were having a conversation about this, not on the podcast, just offline, that I told him he needs to write a white paper about these valuation metrics that our money supply, M2 money supply.
Could you imagine? All right. If Nick...
He's a busy man, so he doesn't have time to do it. But
if they did a white paper in regards to normalizing valuations when taking into account money supply,
Pulitzer Prize winning.
I like where this is going. I mean, this is pure speculation. This is my compliance disclaimer. Pure speculation. But I'd argue the person that doesn't like that stock at 22 or 23, but looks at the pricing on an equal measure of money supply 5 years ago to now, you're probably in the high teens.
Yeah.
I just think that is such an important topic that Main Street, Wall Street is not even discussing.
No, it's not even an item they bring up.
No. But it's tough to value these things when you have a currency that's been increased so dramatically.
Yes, absolutely.
The amount in circulation. I love these topics.
They were good, right?
Well, I know we're getting close to the end of the podcast here. We got Thanksgiving here in 2 days. AC, thoughts, comments you want to finish with?
Hopefully this Turkey Day rally continues, and I hope listeners have a wonderful Thanksgiving. What's your favorite Thanksgiving side dish? Jenna and I were talking about this.
Okay, let me think about this here.
Or main dish. What's your favorite item?
First of all, I think cranberry year-round is an underutilized fruit. So
Interesting.
I love cranberry. Okay, so cranberry sauce, put it on everything.
All right.
Okay, so that would be my favorite.
That's
side.
a hot take.
You think it's a hot take?
Yes.
I don't think it's a hot take. And then, of course, I love deep frying my turkey. So I love a deep fried bird. What about you?
Mine is corn pudding. Memphis corn pudding. It's my jam.
I do like that. What'd Jenna say?
Oh, mac and cheese.
Mac and cheese.
She's saying mac and cheese.
Yeah, I like some good mac and cheese. Yeah, everyone's got their plates, right?
All right.
Do we know how Nick is doing? Did Nick talk last week about how he's doing in his fantasy? I know we talked about it a couple of weeks ago.
I think he's having a hard time. He's having a rough year.
Is he still he's either second?
He's bottom tier.
Oh, no. That's not good for Nick.
No. He's got I know one of his leagues got some pretty good dough on the line, so he's probably going to be hurting later.
Oh, no. All right.
And bragging rights, most important.
Yeah, we'll be thinking about Nick on that front.
Absolutely.
All right, everyone. Thank you for listening to episode 328 of the Independent Advisors Podcast. We'll be back next week with 329. We'll sign off.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.